Hi, everybody. Barry McGuire here for Barry McGuire's Creative Real Estate Education Series. It's the Monday main event. We meet up every Monday at 5 o'clock Mountain and talk about things related to creative real estate. We talk about rent to own and agreements for sale and fix and flip and joint ventures and other creative things. And to help us out, we have people on. We have mortgage brokers. We're going to have at least one broker today, appraisers, insurers, lawyers who specialize in real estate things, especially on the enforcement side, accountants, developers, anybody who's got some expertise to help us with our quest to have successful creative real estate deals going on in our collective lives. We also do focus workshops. Many of you have attended. Those are day-long or two-day-long events where we really dive deeply into a strategy or strategies. We did wholesaling in Calgary, first full-time or all full-day focus workshop on wholesaling. That was really great. And then we followed that up with agreements for sale, AFS in Toronto. And then on May 27th and 28th, we did our famous Rapid Cash program here, 2 days in Edmonton. Really illuminating, a lot of fun to do, lots of experts, and tons of great material. So that is what we do on the as a group, my wife Donna and I, and on the Monday main event. The last 2 weeks in a row, we have spoken and discussed private lending. We're doing a series on private lending, and the first two were really on promissory notes. We hear it a lot. People want to lend money and borrow money by way of a promissory note, which is a debt, what they call a debt instrument. It's a contract where borrower and lender set down what the terms of the loan are and what's the deal between them. So we talked about promissory notes, just what they are. Then whether they are secured or unsecured. In other words, do you have more than a handshake? A promissory note that doesn't have some collateral security, some security of some sort, is really just a handshake. So we talked about the secured and unsecured aspect of them. And then we had last week an hour-long discussion with lawyers on from British Columbia, Alberta, Saskatchewan, and Ontario, where we talked about how promissory notes worked in their province and how that's different. So the concept of a promissory note and the wording around a promissory note is pretty similar in all the provinces, but there are some subtle but important provincial differences. So if you're thinking of lending, make sure that you chat with your own lawyer in your own province to make sure that those subtle provincial differences don't mess you up. So that's the last couple of weeks, and we're carrying on with our series on private lending today with kind of a discussion on the true private loan. That's the loan between individuals. So you're not out borrowing from somebody who's got $1 million and does loans on the side and maybe has a little company to do it and does it as a business. This is just the true private loan, two individuals lending to each other. And what that means, what you can do as an individual who wants to lend to protect yourself and why you should do things like that. And so we're going to talk about some of the principles around making a loan. That's called underwriting. When you ever go to a bank and get a loan and you talk to your mortgage broker, they might say to you, well, we sent all the information to underwriting and they're going to look at it. Underwriting is the process of looking at the diligence that you've gathered in on a loan, whether it be you as an individual lending or whether it be the quotes underwriter at a big bank. It's gathering in diligence and looking at it and applying your principles of lending to determine whether or not you actually want to make that loan. So that's the background. That's what we're going to talk more about today. And to help us out, we have a great crew today. We have Sean Impey. We have Sean is a mortgage broker with experience in lots of different areas. We have Keaton Kirkwood, who is also a mortgage broker with lots of experience. And we have Neil Taniguchi, whose claim to fame is he's borrowed lots of money.
And he's not a mortgage broker.
Not a mortgage broker, but he's borrowed lots of money, and I'm pretty sure paid it all back. So we always like to at least get a brief history from our participants. So Sean, just give us the busman summary of who Sean Impey is today as a mortgage broker and how you got to being a mortgage broker, just a little bit of your past history so people can understand where you're coming from.
Well, I got my mortgage broker license in May of 2017 after 35 years of working in the construction industry, mostly heavy construction, oil sands type stuff and everything else. So I did that and retired. I had lots of investment properties. So I thought, well, I'm too young to retire and don't like sitting around the house. Neither does my wife like me sitting around the house. So I decided I would choose between a realtor and a mortgage broker. And I looked at the costs and expenses and what you had to do. A mortgage broker came out far ahead of that. So I focused mostly on investors, show up on your show every so often and some other real estate investment meetings, find people who are looking generally to buy investment properties. I still do the owner occupied and everything else that people want to do, but a lot of mortgage brokers shy away from the investor side of things just because it's hard. It's, you're dealing with multiple rental properties and other things that you got to know which bank to go to and stuff like that. So it's kind of it in a nutshell.
Okay, well, and when Sean says he was in the construction business, the oil sands type stuff for a while, he was a senior guy there manipulating large numbers. Not that there's any shame to being a guy on the tools. I know lots of guys who have worked in Fort McMurray and saved their money and done extremely well for themselves. But Sean was right up there in the construction industry as a senior guy.
I can't even drive a backhoe, so I wouldn't be any good to do anything physical. So I drove the desk. Yeah.
Well, Sean's big enough he could lift those backhoes. He didn't have to drive them. So, all right, let's move on to Keaton Kirkwood, who's recently living on a very nice property here near Edmonton. Keaton, give us your background and how you got to be a mortgage broker and some of your history so people know from whence you come.
Sure, I'll just give the quick one. When I was 21, I left the Okanagan, the land of no jobs, and moved to Alberta and worked in oil and gas for a few years on drilling rigs, and got sick of working on call all winter very quickly. So I moved back to BC and got into car sales because I wanted to learn the sales industry. Spent about 8 months doing that and realized that it's a great place to learn, but not the career I wanted. 2015, I got into the mortgage world and started on an investment-focused mortgage team. Promptly got kicked out of a Keyspire event, got into Keyspire as one of their brokers, worked with Rain and REAG and a bunch of smaller groups. And it's been 8 years now of working with investors as a mortgage broker and own a couple investment properties myself. Recently moved back to Alberta because I loved it so much. And it's kind of me in a nutshell. Got 2 kids, 4 dogs, 2 cats, 2 bunnies, 2 horses, a mini horse. So I just need the arc.
You're doing pretty well. Lots of 2s in there.
Happy wife, happy life.
Yeah, no doubt about that. I'm as I say that, I'm trying not to glance left at producer Donna here.
I'm sorry, guys. I'm not being modern. I apologize. It's happy house.
Yeah, come on. And let's move over to Neil. So Neil is not a mortgage broker, but he's also got an interesting history. So Neil, give us a bit of your history.
Well, I'll tag on to what Keaton said. I never intended to go into automotive, but I was in the car business for way too many years. I think I ended up with 17 years of retail, finished as a sales manager for the last 9 years at Calgary BMW. And I will say this as a quick plug. You learn very quickly how to pivot on a dime because no two situations are the same. So no day is the same. And I have watched people who do well in that industry move on to do very well in other industries because a sales background helps. Anyways, we got our first rental property. It'll be 21 years ago this year. So it's kind of been a while. And we started with rain. We were doing the buy and hold thing. Don Campbell for years would say your real estate portfolio should be boring. And right, and just keep paying it down. There's a recognition that the cash flow that was in our buy and hold, even though we were growing it, wasn't going to be enough to replace one, let alone two jobs for us. And so we took the precursor to your course back in 2009. We were all in Edmonton, about 400 of us in that room. And we learned what was then called Quick Turn, which now is named the Barry Maguire Rapid Cash Program. And so we started doing agreements for sale. We started doing rent to owns, and we layered that on top of our buy and hold business. So we still have the majority of our buy and hold properties. That's our pension plan, quite frankly, because I didn't have a pension starting out. The rent to own and the quick turn and the rapid cash elements are what have allowed us to. I'm closer to 10 years now than I am to 9. In terms of being full-time as a real estate investor. So I say I've become unemployable because I loved the industry and the challenge and the car business and the people and development and mentoring and all of that stuff and the product. I didn't like the time when you look back, and to spend 40 and 50 hours, maybe even 60 in a rewarding career still meant I was spending 40, 50, 60 hours away from the things that matter. You know, that whole, if you had one more, you got the call from the doctor, you're not going to spend one more day in the office. None of us are, right? We are all going to go spend it with what matters to us. Rain taught us that years ago, what's your beliefs? And that's usually it boils down to friends and family. So short version, by doing rent to owns, by doing agreement for sales, we were able to, it supercharged our cash flow. And we're able to buy houses with no cash, very little cash, no credit. We started doing, today's topic, private lending. We ran out of capital like a lot of people. We did joint ventures, and then we got over that hump and we were able to get some corporate lending. But we were still, about 5 years ago now, when I was helping with the courses that you and Donna run, you brought on the fix and flip. Man, like they blew my mind. What are they now at? 400 properties? Janet and Roman?
Yes, over that.
Right. So really successful in that industry. And we went, So 5 years ago, we added another arm, so to speak, to our real estate investing. And we started doing fix and flip. And so private lending is definitely a part of what we do there. So we have buy and hold, we do fix and flip, we do rent to own. I'm putting an offer in on a house in the next little while here. People say there's no deals out there. When you go into a house and I wasn't even there, I'm out of town right now. And my realtor went and looked at it and he goes, "Ugh, smells like cat in here." And of course, everyone in the room knows when it says it smells like cat, what it really means, it smells like
money.
So we're going to try.
Okay. Well, thank you for that, Neil. Thanks, you guys, for giving us the history. It's important for people listening to know that the people on here are people who are in the trenches themselves, doing what you're interested in doing, and not just flapping their gums from reading a book somewhere. So that's important to know. All right, so today we're gonna chat about private lending from I guess, Keaton, what you said to us a bit earlier. True private lending is really loans between individuals. So we're gonna chat about that a little bit. And carry on from our discussions last week with our crew of lawyers about how people lend privately and whether they do any or adequate diligence on their borrower I want to get into today what can they do, and maybe what should they do versus what they actually do. And before we do that, or as a precursor to that, Keaton, you made some comments when we were discussing about coming on the show about loans between individuals and their rate of success and their rate of generating failure in lawsuits. I wonder if you could maybe talk about that some more and expand on what you said earlier and what your observations are for those true private loans.
Sure. So part of our journey as brokers, my business partner and I, we left Dominion Lending Centers in February and started up our own brokerage or franchise. And we were dealing with our errors and emissions insurance. And one of the little stats that we got from the industry, and I'll paraphrase this, but private lending, so individual to individual. Sean lends me money. I'm borrowing from an individual rather than a mortgage investment corporation, which is a pool of funds. Those individual to individual private loans, roughly speaking, represent about 12% of the entire mortgage broker pool of volume, yet they represent nearly 60% of all lawsuits involving mortgage brokers. So they are it's a higher risk type of lending, but it's also a more flexible type of lending.
Okay. All right. So that's what your professional organization tells you, that 60% of the lawsuits involving mortgage brokers are the true private loans. So
to the point, they price our errors and emissions insurance on the percentage of private lending we do.
Yes. Okay.
It's pretty important. Right.
So trouble for mortgage brokers and trouble for individuals, I think. Individuals lending to each other are almost always or frequently people who have never set up a loan. Their business is not lending. So they don't know how to set up a loan, and they may never have lent money before. And on the borrowing side, if the borrower has borrowed before, likely they've been to their bank or their other credit granting facility and said, I need a loan. And then someone else is asking questions and setting up the loan. So one of the things about two individuals lending to each other is they're almost always quite inexperienced. And so lending, like any other endeavor, is something that has rules that you can apply to a situation and to limit your risk and to have set up a loan properly and have a better chance of success. So Antonio is one of our lawyers. Antonio, like Babette Turner, is in Ontario. Highest claims against lawyers, biggest area of fraud in real estate law. Well, thanks for that, Antonio. That's that's true.
Thanks.
No, I mean, I didn't mean thanks for that, Antonio. I meant that was a true thank you.
And that's a wrap, folks. We're good for the week.
On to the next topic. Here we go. So in the true private loan, I think anybody who's listening, this is not the hearts and flowers part of our series. Lending is not glamorous. Lending is checklist and diligent oriented. And if you're not the sort of person who wants to do checklists and diligence, either because you know how to do it yourself or because you're prepared to get some help doing it, then you have to realize that there is a big chance that your loan as a lender will fail. It'll fail. There's plenty of people who want money and plenty of people who will say anything, plenty of people who will create a Facebook page and then reach out and post videos and convince unsuspecting folks to lend them money for no good reason. So if you're an individual who wants to lend money, that term private lending, it's got sort of this mysterious cachet. People say private lending. It's like it's some golden globe. Sorry, I'm gesturing. It's like some golden globe out there. It's in the sky. It's right there, and you could just reach out and get it. It's like what's another thing? It's like multifamily investing. People say, I got to get into multifamily, got to get out of these things, got to get into multifamily because that's the holy grail. And, you know, it's just not like that. So, all right, let's talk about it. Somebody wants to lend $5,000. Keaton, I'm going to go to you first. Somebody calls you up and says, my buddy wants to borrow $5,000 from me. You know, what should I do? Now, Keaton, assuming that you would chat with him, and I'm not, folks, I'm not saying Keaton's going to talk to you if you want to do a $5,000 loan. All right, well, why should I put words in your mouth? What would you say if somebody calls you up and says, you're a mortgage broker, my buddy wants to borrow $5,000. What should I do?
I would probably suggest that they don't do a mortgage in that case, because you're going to have such a large cost of the, typically speaking, a private borrower will pay their legal fees plus the lender's legal fees. There's other costs. The last thing you want is 50% of the cost of your loan is simply administrative costs. At that point, you'd almost be better off as the lender. You could have half your money back before you even start. So personally, I would suggest that there is an economy of scale with private lending. And as you get smaller and smaller, you lean more in the favor of the prom note side. The risk is also lower for the lender just because it's less money. But that's my own personal 2 cents on that one.
Yeah, I kind of get that. Sean, what about you when somebody wants to talk about a small loan?
Tell them to put it on their credit card.
Exactly.
That's just exactly what Keaton said. It's, you know, even if you go the promissory note registered on title route, you still got quite a bit of expenses, and you know you can only charge, you know, so much for expenses before you become usury and stuff like that too. So, I would never want to do anything that small. So, and if it was a last resort, I'd be asking the potential borrower, or sorry, the potential lender, like, if he needs $5,000, he's got to be pretty hard up. So you got to be thinking that maybe he's in trouble or something like that to need $5,000. So little due diligence is required on what he needs the money for, what's his exit plan, and everything else.
Yeah, I agree. And if they called me up and said, Barry, I'm going to lend $5,000, what should I do? I would have similar advice. I would say, well, if you want me to be involved and draft security, if you're looking to get some decent protection, some proper diligence done, and some decent protection, you know, your legal bill is going to be $1,500+ at least, and maybe you can get your guy to pay. But small loans don't lend themselves to getting professional help to protect yourself. Neil, what do you got to say?
I can give you the counter opinion to that as the borrower, and maybe even as a lender, but I'll start on the borrowing side. And just to rephrase what Keaton said, so folks, if I want to borrow 10 grand from someone and I offer to pay them 10%, easy math says they make $1,000. That's what my interest expense is. That's what their income is 1 year later. But if the legal charge to put that money on there is $1,200 to $1,500, it just meant that my 10% rate just went to about 22 to 25%, which is why it's not economical to do it for such a small amount when you're borrowing. You know, and it's even worse if you're only borrowing 10 grand for 6 months, because all of a sudden you went from the 10% doesn't change, but that $1,200 or $1,500 for the lawyers now is double. So you're more like 30% in what you're
Don't
effective.
forget that $1,200 only covers half the legal costs, because there's also the lender's legal side.
Fair enough.
Yeah, and it is pretty common,
right,
for the lender in any commercial situation or quasi-commercial situation. The lender never pays his own legal account. That is always for the borrower. So the borrower has to pay his own account and the lender's legal account, and then things add up pretty quickly if that's how it's going to be. So I don't.
Yeah. So typically, just to finish that, if we're trying to borrow on a private mortgage, we're looking for usually borrowing a larger amount, like everyone was saying, and B, a longer term, right? A year and maybe 2 years, and somewhere 50 minimum, maybe $100,000 at a time. So how does the $10,000 loan for us work? I actually have one where I was chatting with a friend, because It's an old high school friend, and he goes, "Hey, you're pretty good with money." I went, "Not if you look at some of the flips we've done, but." And what I said to him, he said, "I have some money. I've been squirreling this side. I don't know what to do with it." And I said, "If you're interested, I'm at the time I'm collecting. I wouldn't go out and solicit 10 grand, 10 grand, 10 grand, because in one call, we can normally make that happen. But in this case, you do it because you're helping someone else. And today that 10 has grown to 30. So usually if someone says they have 50 to lend you, they probably have 100, and they may even have more, but they don't want to put all their funds, like going to the casino and saying, I'm going to put it all in red in just one throw. So I did it that way. And then again, one of the things that came up in some of the previous things, the security, the not security thing. Yes, I've done some promissory notes that are unsecured, and people were character lending to me because of who we are and our long-term relationships. So some of our long-term investors, I've said this for years, and quite frankly, we should secure them just so it's consistent across the board, not go, well, this one is, this one isn't. So that's a process we're looking at changing. But to get back to the 10 grand guy, and this is where I'm going to go and talk to the guy in the Hollywood Square above me, we use a promissory note tied in with a memorandum charging land. And the promissory note includes the legal description, and the memorandum charging land. I've been told by more than one lawyer that it is as enforceable, again, in Alberta, because from listening last week, man, there's so many different ways in provinces, but in Alberta, that it is as enforceable as a mortgage. And I don't need a lawyer. And again, there is a trust factor because of these people who are coming to me, and we establish it that way. And then I'll say to Barry, is that what your opinion is on a memorandum charging land?
Yes. A memorandum charging land is a specific security defined in the Land Titles Act, and it is registrable against the title. And so it is enforceable. It is enforceable like a mortgage. A memorandum charging land is, a briefer security document. Mortgages run 15, 20, 25 pages, depending on who's drafting. And the memorandum is a much shorter document.
2 pages.
Sorry, how many?
2 pages, double spaced, not even small font.
Okay. So it's way better than a note that has no charging provision in it. Certainly the next one up is in Alberta, the one that says I charge my land with repayment of the debt. And next up to that, before you get to the full-blown mortgage, is the memorandum of understanding. So you can layer the type of security document you get here in Alberta. And for other provinces, you're going to have a chat with lawyers there to see whether or not they have those layers, or whether or not there's a way to do something at the lower end of the lending scale that gives you some protection, but doesn't generate professional fees that are out of whack with the amount being lent.
And we've used those same things, by the way, as lenders going the other way. If we had a rent to own exit and it didn't quite there, in the times when the market went the other way here in Alberta and they were short, we'd reduce the price to get them done. And then also, in some cases, not only reduce it, but we would use that same note as a lender to say, you still owe us some money. We're going to secure it on your future title in the wording. And again, it was vetted and said, yeah, that's still enforceable, to the point where there's a lady who is an RBC foreclosure lawyer in Calgary. And when that person who had borrowed from us just decided to file for, it wasn't OPD, it was the other one, a consumer proposal.
Mm-hmm.
We sent her multiple notes saying, we are a secured lender. We confirmed that we're considered a secure lender because we had it filed on title. So secured creditor, sorry, so that she was obligated to still make those payments to us. She did not. And so after I had no response from her and I was getting close to my 2-year limitation period, I sent it down to the RBC foreclosure lawyer. Might as well get a specialist to do a specialist job. Singers sing and dancers dance. She sent the letter. Now, whether or not the lady came back and said, "Oh, I didn't know I had to pay them." Well, you kind of did, or you didn't talk back to us. The short version is she's been paying us for the last 15 months, the money she owes us, and it isn't a whole lot. It'll be paid off in the next year. But on principle, I'm going to get every last dime from her.
Right. So taking security is good, and it also can help on a rent-to-own situation. So that's good. Now, Keaton, were you saying something there?
Yeah, I was gonna share a personal blunder I made that fortunately didn't end terribly early in my career. But I lent on a prom note, and I, being a newer broker, was like, I need security because it was a moderate amount of money, and I added a right to register a second mortgage on a specific property address on the prom note. Everything's great, had legal advice, blah, blah, blah. Found out about 9 months later when I started to get worried that while I had the legal right to register the second mortgage, if the borrower hadn't signed the mortgage paperwork preemptively, which didn't exist when we did the prom note, there was no way I could actually register it because I didn't have a mortgage document signed, and they would have to cooperate to sign it. Now, fortunately, in this case, the borrower did sign it and we enforced it. But I think it's important you ask your legal advice, can I enforce this, and what barriers are in my way? Because I had a close call of having some sleepless nights.
That's a great
good one. Yeah, the right to enforce something that doesn't exist with a now uncooperative debtor is not going to do you much good. Gotcha. Sean, how about a personal story from your end on loans you might have made? Now, I don't want to put you on the spot. If you don't want to talk about stuff that's gone sideways for you, that's fine. We've all had stuff going sideways, but that doesn't necessarily mean you want to tell the whole world about it. But if you have a story, good.
We had a mortgage on the second mortgage on some properties, and we were well covered with security at the time we did it, and there was offers to purchase on the table for a couple of months out for these two properties, so we would have got all our money back plus the interest and costs and everything else. So came time to close the two sales, and surprise, the seller could not, which is our borrower, could not close the deals for whatever reason. We never did find out, and you have intimate knowledge, of course, of this case, this one. And it took another year before the properties were sold. Of course, us being in second spot, we just watched the interest pile up on the first mortgage. So we decided that we had to do something. So we ended up foreclosing. And if you're in second position foreclosing on something, you have much less, or maybe no equity left. So the courts are much more anxious to get something done for somebody who has no equity left versus the first mortgage we were foreclosed. He had all the equity that was our second mortgage, so there was no panic. He could milk this for another year and sell properties and still get his money back even after the renovations and stuff for the finishing the project had to get done there. So we were far from the only ones who got burned a little bit by this particular investor, and there's multiple stories out there of promissory notes and stuff that were done and were not registered on title. And when we pulled title, we found a whole bunch of stuff on there, and the way we got it done is they just kicked everybody else off and left the first mortgage and us on title. But it was still a bit of a learning experience. So I've had lots of promissory notes go well. So I got about 3 private loans out there. One's a mortgage and two are promissory notes with your template, Barry, there that you can register on this property and everything else. So don't intend to register right now because there's the original loan to value is 50%. So it's not very big. So there's not real panic to register unless I smell something going on there, and then we can register. So just got to keep an eye on, make sure the guy's paying. So,
all right. Well, Sean, that's a good lead in to a bit more detailed discussion of if people, if folks are looking to lend and they want some coaching on what you guys as mortgage brokers look for. The the 3 C's of the 4 C's of credit, why and how you get some of the information that supports those decisions. Let's talk about that aspect. Keaton, let's start with you here, and talk to people about things that they can look at, things that you look at when you're looking to make a loan.
I guess
get a
we'll
loan
start
set up,
with
I guess.
The 5 C's of credit are, which are capacity, capital, collateral, conditions, and character. I think they're of varying importance, but the big thing to remember is that private lending, just because something's secured on title, does not mean it's safe. And maybe after we should touch on what happens if you're in second position and maybe they're in default with you, but the first position loan's in good standing and doesn't want to go anywhere. But I think the biggest thing is to understand who the borrower is, what they're doing, and what the strategy is. The most common mistake I see lenders make is they'll lend on, let's say, a flip, not understanding what their valuation is based on. Is it ARV? Is it current value? And not contemplating what the cycle of the process is. Not understanding that if the flipper rips the property in half, goes, uh-oh, there's something I can't deal with, and then walks away. Maybe it was purchased for 200, is worth 130 when you foreclose on it, and the ARV is 400. Well, if you lend at 80% loan to value on a $200,000 property, that's 160 grand. But if they've just gutted it and now it's a non-livable property, you could be out very quickly underwater, and you had all the information to know this could happen, but you have to have the experience to connect the dots. And I would just say that understanding the process of what the deal is and what the exit strategy is the biggest piece for me, because I think we all know to look at, how are they going to pay it? But I think that's the one piece that many investors miss.
Yeah, on the creative side with that have other wrinkles and crinkles, the fix and flip example that you just gave, I think that's a great example of a lender needing to understand the process so that they can properly lend. So we talked about the 5 C's, but Sean, let's move over to you. And what do you think is the most important thing you like to look at when
I'm going to piggyback a little bit on what Keaton said about flips and not knowing what's going on. I mean, I've had people come to me say, I got a flip going, I need some money and stuff. And I said, well, let's sit down and let's look at all your numbers and, how confident are you of the ARV and everything else. And I have had more than one deal just fall apart or go off the table because they thought they were going to make 50. And when we did all the numbers and looked at it, they might make 10. Might make 10. I said, you're taking a lot of risk and stuff there for $10,000. You can go buy something out there and not take that risk. So, it's important to understand the flip. So if there was a borrower and a private lender involved and they were talking to me, I'd want to make sure that, my lender was well protected there and know what the borrower knew what they were doing. They'd done flips before, understood it, and they had realistic expenses and everything else in there. And just to sidebar, way too many flippers don't start with a realistic ARV. They start with the sale price and work backwards and say, I got to sell it for X number of dollars to make money. Well, X could be like, value plus 50,000. So, so you gotta, as a mortgage broker, you really got to protect your lender and know what the exit plan is, which is a major one. And, if they can't sell it as a flip, they keep it as a buy and hold. So, I also find that I have people come to me and say, hey, my buddy's going to lend me 50 grand. Can you help us, do a mortgage or something like that? And has your buddy ever lent money before? And have you ever done anything before? What's going on? Well, no, we're just going to sign up a promissory note or something. He knows I'm good for it.
Oh, famous words. You must, I cringe when people come and tell me a version of that story, and I hear it all the time. I'm sure you hear it. Keaton, that's probably maybe why you don't, you might advise a borrower a little bit, but probably you don't want to advise lenders very much on them.
Yeah, that was one thing I was going to add, is that make sure you go to the right professionals. Like Sean and I are both very investor focused, but Sean, correct me if I'm wrong, is much more focused on private lending than I am. For me, private lending is usually it's a situational thing. Usually someone hasn't paid taxes or something. I'm not a big fan of private lending on flips and certain things, because I'm just a believer that if you're a sophisticated enough investor to do it, you don't necessarily need me. And if you do need me, then maybe you're not sophisticated enough to be doing that strategy in the first place. But
Right.
I can chime in on that though, because Sean, you'll remember this, about 2 or 3 years ago, I reached out to him because we were within weeks or maybe even a week of closing. And I think what had happened was we had bought a couple properties and we had tapped our regular source of capital. And I just wasn't sure whether I was going to get there. So we didn't get very far, Sean, but I said, hey, do you have access? He says, yeah. And here's what you're going to have to do. And I said, sure, I can do all that. I ended up funding it within our regular first layer of network, but certainly there was a period in time where we were going, well, plan B better not be hope. Plan B better be something that is solid. And in fact, we just finally did our first Calvert mortgage back in February because, again, some guy named Neil doesn't know how to moderate. And we had taken on our 7th flip property and I had truly tapped out the network. And so I said, I could probably fundraise if I went out and in there and who do you know and all that stuff, or I could just make a call and get it done in like they do in 24 to 48 hours and had it funded that way. So there are times when, again, at in some scales, you'll get some people who just have a situation who aren't first timers. Now, if I'm going to go lend to a flipper, because I have lent to flippers before, I definitely want to echo what you folks have said, and I want to look and see who their track record is. You know, have they done a bunch of these before and have they made money? And if it's someone who wants to do a first time one, it's not that I'm going to say no. I may insist on being first position in on it so that if it does go sideways, but you want to make sure that you've independently vetted the numbers that they're giving you. So it's the same version of, in the old days, a joint venture pro forma. And you look at the numbers, you're going, well, where's your management expense? Where's your repair and maintenance? Where's your, right? And some of the pro formas that we have seen over the years are just not worth the paper they're written on. So by the same token, if someone's presenting a flip to me in a neighborhood in Edmonton that I don't even know, I'm for sure going to get on the phone. And I think I did that. Actually, it wasn't with regards to a flip, but it was when we came up to Edmonton for Rapid Cash, and one of the students had a lead on a house, and Donna said, "Call Michelle." And so I did, and he said, "Well, here's what I know about this neighborhood," and we realized it wasn't a deal. But you want to vet the numbers and not just trust blindly what you're being given by someone who's, especially at no insult. We all started somewhere. But it would also help their confidence to know that their numbers are solid going in, because you can give them that vote of confidence. And like Sean said, you might also be able to save them from a whole lot of hassle and hurt when it goes the other way, because they trusted numbers that a realtor who was either inexperienced or was just trying to sell them something, or they're so gung-ho to say I'm a flipper, right? And I posted about that we just sold a flip on Saturday, and I posted about that. We got lucky. The only reason we were on our way to a 6-figure loss on that one. And we got lucky that the market in Calgary shifted just enough to help lift the property value. And that luck is not a great business strategy, because if it had just stayed where it was, that would have been an owie. We would have made our investors whole. But to absorb a hit like that is not something a first timer is going to do. And again, some of the people saying, "Jeepers, Neil, you're telling people that nearly happened." I said, well, I've posted about the flip we lost money on. And we lost money on that too, because everyone wants to say that, oh, flipping is, you're guaranteed to make money. No, you're not.
Boy.
And
then
Calvert is they're a very thorough lender. So the ARVs that they use are often less than what the investor flipper thinks the market's out there, and
they did that with me.
They really scrutinize. And if someone comes to me and they don't know about Calvert, then they're a rookie, because anybody in the flipping business knows who Calvert is and what they charge, and their $10,000 down program that they have there sounds great, except you still have to have all your rental money, and they
Right.
charge you about 16% on a fee. So, I've done Calvert mortgages where I've helped them out and I've added a fee on to do that. But if they're experienced investors and stuff and come to me for maybe an alternate to Calvert, go see what Calvert's going to give you first and figure it out. And if, maybe we can beat that, but I'm not going to waste a lot of time chasing after money for people that are just shopping me against Calvert up front.
So Neil, you went to Calvert. So Calvert is a company called Calvert Home Mortgage Insurance Corporation. They've been around a
Investment
long time.
corporation. Yeah.
Yes, I think they've been around since maybe the 60s when Dad started out the program, and sons are now running it. They operate in Ontario. They operate in Alberta. They're out Calgary based. And Neil, so you went to work with them. Now I've seen their paperwork at the end of the deal, but was it instructive for you seeing what an experienced lender like Calvert required from you as you're looking to do the loan?
It was a good way to learn how they go about vetting things, and so in my head it was, again, if I'm going to go down that lending route, it might give me a few more tools to put in my box and how I go about vetting things. So they gave me basically a spreadsheet that said, fill in this, and this. We needed proof, like Sean said, that we had the funds for the down payment and to fund the renovations. It wasn't, we'll go fundraise that after we take possession. So they needed to see that we had the money in the bank now, and we were able to show them that. And like Sean said, I tend to try and run a very, very conservative ARV when we're doing our flips, because you don't want to be stretching. When you're stretching to try and make the numbers make sense, it should be a sign that that's not the right project. So we do conservative on it and say, okay, if the profit's decent on a conservative ARV, everything else becomes gravy, rather than going, this is what we need, and it gets knocked down to where you're working for 10 grand. And I also learned, though, so I had a conservative ARV on that townhouse of 525, and they said, well, we're ARVing it at 500, but we'll still lend to you. And we ended up selling it at 575. So we both, the market lift helped us, but you don't know going in. One of the reasons why townhouses are a decent thing, by the way, is you can get those flips done a whole lot more quickly than the 2-year one that we just finished up. I don't even want to look at what my interest bill is on that one.
Nasty.
Right? That's why we were heading for that kind of loss. And we had projected a sale price of $1,050,000, listing it for 1.1, right? Being conservative, going, well, if we're lucky, it's 115, and we sold it for 145.
Woo.
So,
I like my flippers.
budget on interest. People say
in the
again.
game.
Yeah,
I like
we had a
flippers.
conflict there. What were you saying, Sean?
I say I like flippers to have skin in the game. So if they got X amount of dollars, I don't know, they say they got 25% of the value of the property, then, I have a number of private lenders who will lend the 75%, and you use your 25% for the down payment, and then the lender has a draw mortgage that, depending on the value of the renovations, he'll loan you that money back on a draw basis. So as you improve the value of the home, he'll give you money for it once things are done. So the value is going up, so he's willing to extend his underlying loan a little bit, but the flipper always has that, 25%, which could be, $75,000, whatever that number is. So you really have to evaluate it and see what the right fit is for people. It gives them more motivation to get things done, because you need to get that draw money to carry on.
Let's chat a little bit about realistically, what can individuals do? We're back to our individual lending to individual situation, and the lender wants to be a little more careful than, as Neil would say, it's a character loan. You're lending on the strength of what you think the person's character is. So you want to do a little bit of diligence. What realistically, what kind of diligence can a private lender do that's worthwhile diligence? What can they do? I mean, you guys know what you can do. Are there things that you can do that a private lender can realistically do?
Yes.
Okay, like what?
Ask for a credit statement, credit bureau, credit report. And if you don't know how to read them, reach out to someone who does understand how to read credit reports. I've read credit reports for 20 plus 25 years now. So again, I still learn stuff about them that I didn't know before, but in general, I have an understanding of them. And I'll
Get both bureaus too, TransUnion and Equifax. You need both.
Bingo.
Oh.
Because some stuff reports to one and not to the other. And next thing you know, oops.
They could be 750 on one and 620 on another because a collection or some other stuff doesn't show up at once.
So where a private individual cannot himself get that credit report, he can say to the borrower, listen, I need a credit report. You have to get it and give it to me, and then I will either know what to do with it or I will get some help looking at it. And
brokers have lots of rules. Brokers have lots of rules about what they can do with that credit report, and sharing it to unauthorized lenders is one of the things we can't do. So
can't do that. No. So there'd be permissions involved if you're obtaining that credit report through your mortgage broker. But are they, you've read them for 25 years, Keaton and Sean, you guys do that as your business. You know how to read them. Is it realistic to say that if the borrower stepped up and said, sure, here's my credit report, would an inexperienced borrower be able to do adequate justice to analyzing the credit situation if it's the first one they're ever looking at?
No.
One of the things I wanted to add is credit score is meaningless. You can have a low credit score, but actually a pretty decent credit report. And you can have a high credit score and be 4 months out of a bankruptcy. So if you don't know to actually read the underlying meaning of a credit bureau, simply they have a decent credit score means absolutely nothing. Or there are people that I see with 500 credit scores, and my business partner and I will scratch our head and go, why? And sometimes the algorithm just gets funky, or a single issue just overweights. And I think it's really important that you understand that the credit score itself is absolutely meaningless. It's the underlying what comes with it.
Yeah, I have a client who I'm working with right now. It's got a 690 something score, and I know that when you send it in, like Keaton, you understand the Scotia system. They internally rated A, B, or C. This guy came back at a C, and I thought, why? He's got nothing really on his bureau that makes him that, but it just shoots the shit out of his borrowing capacity and loan to value and everything else, amortization. And of course, they won't tell you what the reason is.
Well, I'll add to that because I think it's important for lenders to know. The Scotia letter grade system, as an example, it's essentially a movement from lenders away from credit score itself in the credit bureau, and it's an aggregate of net worth, debt, profession. As an example, if you've got a large real estate portfolio and you're a realtor or mortgage broker, they're going to weight you detrimentally as you've got a large exposure to debt, large aspect of income from rent, and a large form of your earned income is real estate. So it's interesting that even the lenders are abandoning credit score.
Because they just don't reflect properly.
Yeah, and this was not somebody with, he had a couple of properties, want to refinance a flip out of Calvert, and it just went sideways. So it was going sideways, I guess we'll see.
And I think Barry, a while ago, I remember you had, this was probably last summer, you had the credit coach, credit genius. I can't remember his name. I apologize.
Richard Moxley.
Thank you.
Moxley, yep.
And Richard was the one who said, if you're a Scotia client, they're going to weight their experience with you internally before they're going to look at what your credit score is. So it's potentially, I wonder, Sean, if your guy was a Scotia client and maybe had, again, you don't see someone who pays a credit card bill off 10 days late, or not off, just makes the minimum payment 10 days late, never shows on their bureau because bureau doesn't flag until you're late by 30 days. but it shows definitely in their internal system that this fellow does not pay on time. And just, again, not knowing.
Well, there was one little Scotia blip that we could explain and what the reason was, and I don't know. It's just it was when he got his mortgage set up with Scotia, he had a small HELOC, and he thought his pad for his mortgage was going to be cover his HELOC as well, and the interest was like $50 or something. He never really noticed it wasn't coming out of his account until they flagged it and say, "Hey, you've missed like 3 payments." And he says, "What do you mean? It's all set up, comes out of my pad." And of course, he had lates on there. That was a couple of years ago, and
I've got those text messages from Scotia, especially in this day and age of variable rates, right? You think you have enough transferred to the account to cover it, and then you're getting a text message going, "Your payment's overdue." It's like, okay, I'm not going back to Scotia for a while for any more credit because I were a Scotia client. But they just laugh at us right now when we say, "Can we port or keep this mortgage or refinance?" No, right? We've gotten to the point where Keaton's right. We're just too high a risk in the bank's eyes, so we've moved to the commercial side. So one other thing, not scaring away from this, I have a recollection, Barry, over the years of 2 people using a 65% number, 65% loan to value with the following parameters. One was back in the day when Greg Habstritt was still teaching about RRSP lending. And folks, if you can still get your hand on a copy of his book, The RRSP Secret, it's really thick, but it is detailed, and it's still valid today, other than some of the changes that Olympia has put in place. I know you're watching, Denise, so you'll talk about that. But 65%, he brought on the stage that day one of the administrators in the office. So she was a salaried admin person, and she said, "I believe in the product and lending out of my RSP." And she says, maximum 65% loan to value, has to be in a major census area, because I don't want to lend on a property in Rubber Boot, Alberta, that if it goes sideways and you foreclose, you still can't sell it because nobody wants it. So that's maybe more asset lending than it is character lending, because at 65%, you should, there's no such thing as no risk, but you've certainly lowered your risk point. And then that same 65% came up. Dan Heon shared years ago that he had a private lender who said, "Here's a bucket of money, go make me a bucket of money." And he set the same parameters. I don't know if it was coincidentally, or maybe Dan shared with him the Habstritt thing, and it was 65%, had to be in a major CMA, and go make me some money. And so at 65%, the condo association that lent us a mortgage, I said the Condo Act allows you to lend up to 75% out of your reserve fund. But I said, if you want to be really safe, put it in at 65%. And so they set a 65% maximum on doing private lending out of the condo reserve fund.
Yeah. Well, that's a lot of mix go anywhere from 65 to 75, depends. So, and if
I think it's you layer on top of that, people who are willing to do higher risk, right, for a higher return.
Time you get to 75%, you're paying a pretty healthy interest rate in today's market, like 12% or something. You still get, like the 9s or something like that for 65%. So depending on, again, property location, everything else. But your story about Olympia and the administrator saying 65% max, when Olympia rules allow you to go to 100% loan to value.
I've lent to 100% loan to value, but again, that was definitely on the character side of lending. I had a relationship with those people. They were long-term real estate investors with a track record. And in the case of more than one of said loans, I've also had them where they've gone longer than the initial term, but that investor, he made me whole, including all my interest, all my everything. We stayed in touch. We communicated. Communication is always the key. When things are going rosy, you never have a problem until you have a problem. But when things started to go sideways, right, just in terms of his timing, we were chatting back and forth every 3 to 4 months, and we were okay.
Yeah, I never do a loan less than 1 year, regardless of how long they say they need the money for, 3 months or 4 months or whatever, because shit happens, and then you got to renew it after 6.5 months. If you made a 6-month loan, you got a bunch of paperwork and stuff to look after. So,
which is a pain. We got one question here, folks, that we want to look at before we sign off for the evening. If you ask experienced real estate investors raise capital for your projects, what kind of documents should be involved to make it official and repayable from different provinces' point of view? And what percentage of the fees do they charge? Thank you.
It doesn't sound like private lending to me.
Yeah, so that's not going to be private lending. If you're raising capital, you're going to be in the public sphere if you want to do that properly. So that question, Facebook user, is an enormous question with a huge amount of things to talk about. So we just can't get into that today. But that's really not private lending. That's stuff where you got to obey the rules.
Barry, could I add one thing, because I'm going to feel really crappy if we don't share this with people.
Yeah, no, say.
If you're going to do your due diligence in your private lending, there's a few things that suggest. One is that you require an appraisal that is ideally ordered by you because you have the most control, or by a trusted third party, aka a broker. Don't trust just some random appraisal they have. 2, you make sure that appraisal has photos of the unit taken by the appraiser. No drive-bys, because last thing you want is there's a meth lab that blew up in there or who knows what. And if someone's coming to a true private lender, which is you, it's usually the last resort, because you're going to be more expensive than the mix usually. So you just want to be careful that you're doing that due diligence. Always pull title. And if you're going to verify income, check they don't owe the CRA, because that's a big one. And 2, Adobe, the premier version of Adobe, I can edit any mortgage document, anything in 2 seconds. It matches the font and everything. So know the technology, and I don't do this, but people should know that the technology is at the point where people can edit any document in about 4 seconds perfectly. So just be very paranoid in things like bank statements and redundant checking. If you care about something, check it redundantly.
Yeah, good points.
Never accept
John?
a phone number that's on a document. Always Google it and look up in whatever way. If it's a company, could be their buddy at the other end of the line.
So there's folks, to finish off there, on the basic private lending side, it's tough to do a good job of being a private lender, especially starting out. You don't know what you don't know. There's lots of things to do. Sean and Keaton could go on for another whole hour telling us the way they do things, the stuff they look at, how they interpret, how they analyze, things that have gone sideways, the loan to value ratio. There's an incredible amount of information that you need to know about and be able to apply to your situation. So I think I'm going to finish off tonight by saying that the true private loan, individual to individual, is a tough one to do. If you don't know what you're doing, it's fraught with danger. And so just be careful on that side of it. Man, we barely scratched the surface. Neil, finishing comment.
One last question for Sean and Keaton. If I was a brand new lender and I have 50,000 or 100,000 that I want to lend to someone who I either know or I don't know, can I approach an independent broker like one of the two of you gentlemen to say, Sean, Keaton, here's Joe, here's my money. Before I give Joe the money through my lawyer, would you vet this deal for me and charge Joe the fee? I'm going to say to Joe, you got to pay him.
I'll go first because mine's short. My errors and omissions insurance doesn't cover private lending in that capacity. So for me, it's a no. You could go to a broker, but not me. Sean may be able to help.
Well, I do give people insight and basically a consultant fee, but I don't do anything with the mortgage as far as underwrite it or send it through my system or anything like that. There's lots of paperwork to fill out from AMBA and everybody else to do a private mortgage. So that's why I sometimes avoid the smaller ones for the amount of work. And my last comment is don't lend money you can't afford to lose.
Great finishing comment. Well, you guys, thanks for showing up. As I say, we barely scratched the surface. We'll be looking to expand on the private lending discussions and look at other aspects on future shows. So thanks everyone for showing up. And at that point, we'll say goodnight and have a great rest of your evening. Good night, everybody.
Night.
Happy Canada